So tell us something about yourself, first of all.
Okay. Maybe then I'll also switch on the video.
Yeah, yeah.
Um,
Okay.
so obviously my name is Sumit Ramani and I graduated as a computer science engineer in 2006. And that's when I realized that this is not probably where I would want to spend the rest of my life. And then I started looking on the options largely in the area of maths where I could do something. And then read an article about actuarial science, researched about it a bit, and then thought, okay, this is something which I would like to pursue. I was in an IT company then and moved on to Kotak Life Insurance, but in IT team. And I was there in IT team for about 3 years. While I was in IT team, I cleared one exam every 6 months. And every time I cleared an exam, I went up to the appointed actuary saying that I would want to move to the actuarial team. Uh, and Yeah. And while he encouraged me, obviously I wasn't a good fit given I had gained some experience on IT side. On IT side, I was slightly expensive than probably other actuarial students, and I had lesser exams under my belt. But then I continued clearing exams, and
So, which company are you working with right now?
right now I have started on my own. I'm an independent consultant, yeah, and the firm is called Actuaria Consultants. And before I started the firm, I was with Swiss Re for about 4 years, or a little over 4 years, where I was part of second line of defense. And a large part of my time at Swiss Re, I was validating life and health reserving models across the globe. So I essentially did replicate the models that we use in a spreadsheet from first principles.
Okay, okay, okay. That's just great. Okay, so you primarily work in life and health.
Yeah, life and health. Yeah.
Okay, okay. And what would be your advice to young actuaries, like budding actuaries? Like one advice you can give?
Yeah, I mean, don't lose heart. I understand that it's slightly difficult now to get the first job, but don't lose heart. It wasn't easy at my time as well, and I had my own challenges, but it worked for me, and I hope that it works for everyone else. And it's not just a hope; it's also because the fact that we have only 350 qualified actuaries in India, and UK has a lot more, and all of them are employed. The only difference is India has protection gap of about 92%, and a typical developing economy would have a protection gap of about 50%, or a developed economy would have a protection gap of 30 to 40%. So once the business grows, people would need actuaries, and it's about waiting till that time. And while you're waiting, don't just wait. uh, in, Enhance your skills, learn new things, clear exams, learn new softwares, especially like R, and also probably get exposed to data analytics and big data.
Right, right, right. That's the need of the hour, right?
Yeah.
Perfectly. So, what do you think about actuaries working in non-traditional fields, like not in typical insurance? Do you think there's a lot of scope for us to work in non-traditional fields?
I haven't encountered many who are doing something in non-traditional area, but if you call actuaries advising a startup which has got to do something with insurance, I see
Right,
a lot of value that actuaries can bring in.
right, right, right.
Especially the startup guys know what they're doing, but they can't talk in the same language that insurers or reinsurers who would eventually buy
Right,
their idea understand.
right.
So
So,
that's where
yeah.
actuaries can bring a lot of value.
Okay. So, insurtech is the next big thing we can contribute a great lot to.
Yeah, in fact, that's my first assignment, and that's the reason why I did this model,
Right.
which I would walk you through.
Okay. Okay.
So essentially, I'm helping a UK-based insurtech who is trying to break into health insurance market of US.
Okay.
So the underlying concept is fairly simple and established. that you exercise and you become healthier, and hence you have lesser chances of making a claim, and hence you should get a premium discount. So
Right.
that has been established. People across the globe are getting benefit for it. For example, Apple has now collaborated with Vitality,
Okay.
wherein they are offering you an Apple Watch, and in order to pay for the, let's say, EMIs of Apple Watch, all you need to do is exercise. If you do substantial exercise in a month, your EMI is waived off.
Okay. So, do they like give you targets that if you do a certain amount of exercise, you won't have to pay
Yeah,
anything or something like that?
yeah,
Yeah,
yeah. So
that is amazing.
essentially, yeah, Vitality has come up with its own reward points, and now
Right.
those reward points you earn when you exercise so much. So
Right.
they have come up with fairly complex but still easy to understand model.
Okay. So,
And this is also happening in India as well. For example, Apollo Munich is offering you premium discount of about 8% on some of their products if you exercise throughout an year. Similarly, Aditya Birla Health Insurance is also offering you huge discounts if you exercise. So the concept is established. What I'm doing for this guy is that he has come up with a different form of exercise, which is addictive. I can't reveal more details than this right now.
okay.
Maybe when the time comes. But
Right.
then this guy has come up with exercise which is addictive,
Right. Right.
and and it becomes a more easy to sell proposition.
Right. So you're just paying people for going to the gym or whatever the
Yeah,
exercise he's
yeah,
proposing.
yeah.
Paying people to stay healthy.
Yeah. In fact, that is one of the rewards of Vitality. If you exercise so much, then your gym membership fees would be paid by Vitality.
Okay, that is amazing. That's just amazing.
And so this is more on health, but there's something similar on the life insurance side as well.
Okay.
There's an insurance agency called Health IQ, again US
Yeah,
based.
I've heard about them.
Yeah,
They're based in the
yeah,
Silicon Valley.
yeah. And they're offering you discounts of as high as 50% if you exercise, if you play tennis thrice in a week.
That's very interesting. Okay. Okay. So you were about to discuss a model on cancer patients
Yeah.
with us right now. So can you brief us about that?
Yeah, so before we actually delve into the model, I'll first explain the underlying product and
Okay.
also add the relevant disclaimers in terms of the purpose of this model. So the underlying product is it's a lump sum cancer insurance wherein policyholders get a lump sum amount as soon as they are diagnosed with a form of cancer, some form of any form of the cancer. And since we were trying a particular insurance company and a particular product of them, or in this model, I've tried to reverse engineer their pricing model. So essentially, I've done a pricing model, tweaked my assumptions so that the premiums that my model calculates is very close to what they're actually offering in the real world. So, this underlying product was luckily very simple because they have same rates for males and females, and they also have same rates for the age bracket of 5, which means that regardless of whether you're 40 or 44, you pay same premium,
Okay.
and premium jumps at only 45.
Okay, but that
Similarly, at
doesn't that make the model a bit weak?
yeah, so it's also so in when you're in the real world, you also think about simplicity.
Okay.
So it's an underlying product wherein they have modeled in such a fashion that your premium changes every 5 years, and the reason why they would do it is it's an yearly renewable product. So every time your insurance premium increases, you would tend to think whether I should continue with this guy or not. So
Okay.
what they're trying to essentially do is okay, they're not changing premium for 5 years, so most guys would stick around for 5 years.
Right.
That's their hope. Yeah, and their product has different premium rates depending upon the region you belong to, because for US they have enough research studies to tell you that if you belong to a certain area, your risk is higher.
Okay. So this is primarily for the US market.
This is for the US market, but the concept applies for across the globe.
Right.
So I could develop it from what I learned in India and also what I learned in Swiss Re, where I was actually doing models for across the globe. But the underlying concept at a higher level applies everywhere.
Okay.
And that brings me to the disclaimer of the model. The idea of this model is to walk the students through what a simplistic pricing model look like. And in real world, things could be slightly different depending upon what a particular insurers are looking at. But in terms of concept, it's 100% aligned to the actual concepts.
Okay, okay, that is great. Okay, so basically what you're saying is this is a simplified kind of model, but there are a
Yeah.
lot of models in the market which are much more complex.
Yeah, you could make it more complex. For example, the capital that I have used in this model is based on the Solvency one regime, which is based on a factor of reserves and sum and risk. But in reality, today people are actually using economic capital, which could be either something as sophisticated as Solvency two in UK and Europe, or it could be a simplified version of economic capital wherein you still apply factors but apply factors to each risk. So but then the idea of this call or this video is not really to get into details of how you calculate capital. The idea is to how walk you through how you price a product. Yeah. 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 Okay, great. Uh, the, while we are talking about the model, I would also touch briefly upon the best practices in terms of doing a model, because still in India and abroad, most people use Excel to do models. Excel, while it's simple, it comes with a lot of operational risks. You change one cell and everything could change, and you may not really realize. So so we have to be diligent and be clear on what factors you should be changing and what factors should be calculated. While that's one part of it, it's also important to identify the cells and color them in appropriate color so that you know if I were to change something, it has to be in yellow color. Everything else should not change by me. Everything else is a formula driven
Okay,
and
makes
stuff's
sense.
around that. Yeah.
Makes sense. That's
It's
like
also, yeah,
that's like a good practice to do, right?
yeah,
That's so
yeah,
you do
yeah,
it
yeah,
practically. That's great.
yeah,
Okay.
yeah. It's also good to have a sheet, something like what you're seeing right now on the screen, which tells you what each sheet is doing at a high level. Okay. So it also makes a lot of sense to have a sheet something like what you're seeing right now. It essentially tells you what each every other sheet is doing in the model. So someone who is knows the model and using it for the first time gets an idea of what's going on. So we then move on to, you might also realize that I've colored the sheets and they are different depending upon what they are trying to do. The first three sheets are blue or bluish, and they are essentially for configuration. The next two are more, it's for configuration because it has, this model is flexible enough to have multiple variants of the model. But when you go to the green, it has details specific to the model you are trying to price or the product you're trying to price. I'm just talking about the colors right now. And the pricing sheet, which is colored differently, slightly reddish, is where the actual calculations are happening. I'll walk you through all of them one by one, spending the right amount of time on each sheet depending upon how much time each sheet would require to understand. The more time would you spend on the pricing sheet, which is where the meat lies in. So starting with model configuration. So it has two rows because what I was trying to do when I was trying to build the model was have a separate rates based on the area where the policyholder belongs. So the only difference between row 1 and row 2 is this place. Avenel is one area, one place in US, and Alabama is another place in US. And depending upon where you are, your actual assumptions could change a bit. But then everything else in this sheet is same. And we won't spend too much time on it because same information is also there in input sheet. But it is structured in a way which is easier to understand. The idea of having this sheet is to tell you that if you want to make any changes, this is the place where it should be making, and it would reflect an input sheet and then in the pricing sheet. The second is model point configuration. So essentially, when I was trying to understand the product, this product that I reverse engineered, I realized that if I use these model points and if I'm able to get premiums closer to these 20 model points, I've essentially reverse engineered the entire product. And that's because as I said, the premiums do not change for 5 years. So that's why I have 20, 25, 30, 35. And then they also have premium rate constant across sum assured. So premium rate essentially is premium divided by sum assured. In most models, you would have premium rates changing with sum assured, and typically it gets lesser for everything else being same. It gets lesser if the sum assured increases, and that's largely because there's a fixed component to the expense, which is initial expense, that becomes smaller proportion of the premium as the premium increases. And most companies would typically pass on the benefit to the policyholders.
Right.
But in this case, they have kept it constant.
Okay. So how does that affect
So,
the model?
So essentially what I've done is I've also made my assumptions for expenses as a percentage of premium and not a fixed number, because I know that it doesn't change with the size of sum assured. So it has to be a percentage of premium. That was a clue. Yeah. Then the incident rates. Since it's a cancerous product, I will also have to factor in the deaths that would happen. The difference here is that people who are going to die are not going to get any benefit, because that's how the product is structured. You could have a product wherein you get benefit either when you die or you are diagnosed with a disease. But
Right.
in this case, you get benefit only when you're diagnosed with cancer.
Okay.
So that's why I have two incident rates, one for mortality and one for morbidity.
Okay.
And you would see that these are independent rates, and we'll convert them into dependent when we move on to
So we are
input.
using a multiple decrement kind of a model.
Yeah, we are using a multiple decrement. Yeah.
Okay.
And yeah.
That's great. Okay.
So don't the advice to people watching the video is that don't go too hung up upon the numbers here, because these numbers are an assumption for the model. Yeah.
Okay.
And it may or may not be similar to what you see in India or in the models that you have seen, but the idea is that you have to have two set of incident rates, one for mortality and one for morbidity.
Okay. So, Sumit, what is the source of this data? Like,
Yeah,
the
so
data
in my case, I had no real source, but what I did was I went and found out what are the industry rates.
Okay.
So for example, in India, you have LIC rates, which every company uses as a starting point, and then tweaks it depending upon what their experience has been in past.
Okay.
So essentially, that brings in the concept of CT6, wherein you have credibility factor.
Right.
So essentially, you say, okay, I have an industry table, but I have only 60% reliance on it. Rest 40% reliance I'll put on my experience, and you come up with a new table.
Right. So that's just a weighted average.
That could be as simple as that, or you could essentially say, I want to change the shape of the table as well. So applying one factor to the table is a simplistic thing, but you think that, okay, now the shape of the table doesn't align with what I would typically experience. So that would essentially mean coming up with a new table altogether. And you could do that if you have huge amount of data and reliable data. Else you would tend to go along with what industry is using. In my case, I started with the industry table and then I tweaked it so that the model works for me.
Okay. So what kind of tweaking did you do here? Can you just brief on that a bit?
So yeah. So for that, let's move on to incident rates table. I wanted to ensure that the curve looks similar to what a mortality or morbidity curve is. So it should not, let's say, be the mortality rate for age 30 should not be higher than mortality rate for age 50. Similarly for morbidity, yeah. So I had that consideration in my mind, and I also knew that it's gonna increase with age, because that's kind of given, that you know that people become more prone to risk when the age increases. So it has to have an upward slope, and the you see a flat curve here in the beginning, because these guys are charging same premium for a guy aged 20 till the guy age 35. So which also gave me an indication that my mortality and morbidity curve have to be flat for that region. And you can see that in the model point configuration. You see the rates are constant for till age 35. Yeah. So as I said, you could start with one table, one standard table, then you have to play around with it. In real world, you'll play around with it to fit in with your experience. In my case, I had to play around to ensure that the fitting is well.
Okay. So these concepts are basically from CT4, graduation and things like that.
Yeah, yeah.
Okay.
So in fact, this is what I've named the table to be, graduated table or something of that sort.
Right.
Uh, if you see, yeah, mortality table graduated.
Okay.
So yeah, it is the CT4 concept. Do you see the name here in top left?
It's not clear yet. It is gonna clear out in a few seconds, I think.
Okay, anyway, the point is, yes, it's a CT4 concept that you use graduation and you finally come up with a table. Now moving on to the inputs table, which is the heart of, which is essentially the combination of data and assumptions. Data being your model points and assumption being your assumption in terms of what your incident rates are, lapse rates are, interest rates are, what is the MAD or PAD, or MAD or PAD, which is margin for adverse deviation, essentially the extra margins that you are going to add in your reserving assumptions. So this is where everything comes together in terms of data and assumptions, and some bit of calculation as well. I'll walk you through each of the cells so that becomes clearer. Starting with the yellow cell, which is where you choose whether you're doing it for region A or region B. And that if you change it to region B, the things which are specific to region B would get pulled up and everything here would get changed. Cell C5, which is the model name, essentially is the name of, it gives you some indication of which model you are working on right now. Below that, under the heading model point, you have age, gender, policy term, premium paying term and stuff. So the age that you see now is the age for the current model point that is being used, but I've calculated premium for all the model points, which we'll see in more detail when you move on to pricing. So gender also you'll see what male and female. The policy term here is very interesting. Although it's a yearly renewable product, which means that theoretically people may choose not to renew the next year and they can buy a product from someone else. But the fact that the company doesn't change premium for 5 years, it gives me a feel that they also believe that people would stick around for 5 years, and after that 100% of people can lapse.
Okay, so you're assuming that they renew 4 times, right?
Yeah. Okay. But then while they renew, some people are obviously lapsing. Not all of them, but some of them are already lapsing.
Okay.
So that's 5%. That's one of the lapse assumption that I've made.
Okay.
So I'm not saying that 100% of people renew. But I'm saying that after 5 years, whatever people are remaining, all of them lapse.
Okay. And one more thing, Sumit, the mortality you have taken here, it excludes the mortality from cancer, right? It's mortality from other sources.
No, it includes everything.
It includes everything. Okay. Yeah. So see, what happens here is once you get cancer, you get paid a sum assured, right?
Yeah, and then you are out of the book.
Then you're out.
That's where the okay. Yeah, then you're out of the books. That's where the policy terminates.
Right, and if you die directly from the active population, you get nothing.
You get nothing.
Okay.
I mean, it might look unfair, but that's the product. You could add a rider to it, get a benefit for diabetes as well, but then that's the product. And the reason why such products exist because you could already have a life insurance and you don't want any more.
Right. Okay.
Yeah. Cool. The sum assured is I've chosen as about 50,000 and that remains constant, largely because the premium rate doesn't change. The premium is a calculated number and that we'll see when we move on to pricing, and hence the cell has a different color to it.
Right.
Frequency is annual. In real world, you would typically do it on a monthly basis. But since I was already approximating a model, doing it on a monthly basis could have appeared to be something, would have sounded spurious accuracy. While I'm already doing an approximation. So I'm saying that the frequency I've chosen as annual, but given I was approximating a model.
Yeah.
In real world, you would use uh, monthly frequency of premium, and frequency of premium would be anything, but your model would calculate decrements at the monthly rate. In my case, I'm doing it at annual rate. The profit margin, I've chosen it to 12%. Okay. The profit, I've chosen it to be 12%, which essentially has some background to it, but I again can't share the details to it.
So that's
let's
just
assume
the
it to be
profit you transfer to the policyholder, or it's the profit that you expect the fund to accumulate?
Is the profit that shareholders make from the product. It's a without profit product. Policyholders do not share a profit here.
Okay.
It's essentially the shareholders that make money here.
Right.
So it's simplest in a very simple terms. It's like manufacturing a pen at 10 rupees and then selling it at 12 rupees. You make 20% profit.
Right. Okay.
That's as simple as that.
Simple cost plus pricing. Right.
Yeah.
Okay.
But then the way you arrive at the cost is the challenging part when it comes to insurance. And the area is available, but this is one of the rating factors. Essentially, your premium rates changes with area, and that's why it exists. Product type is cancer. Theoretically, you could the model is structured in such a fashion that you can actually price an endowment model, and that we'll see when you go to the pricing sheet.
Right.
But as of now, it does only cancer.
Okay.
And then moving on to assumptions. As I said, since the premium rates do not change with sum assured, I've assumed everything to be a percentage of premium, and hence it's a proportion of premium and not a fixed number, including initial expense and commission. The renewal expense is also a percentage. Lapse rate, I assumed it to 5%, and it seemed to be reasonable to me. Mortality rate and morbidity rate are essentially 100% of the incident rate table that we have come up with. And then you apply some margins when you do calculations for reserving. Risk-free rate is 1% because I was doing it for US business. Because that's essentially what you would get when you are in US. And expense inflation is about 0.5%. That also aligns with US. In India, you might see 6%, but in US, that's about inflation that you would see year on year.
In developed countries, we have those kinds of rates.
Yeah. And shareholder tax, I've assumed it to be 30%. I did not have any pointer to it, but then I assumed, and it seems to be working. So, but then the point is that these are still assumptions. The concepts still apply. Yeah. Right to it is a table called benefits, and that's where you could choose whether this product has a death benefit or morbidity benefit, surrender benefit, maturity benefit.
Okay. So this is basically flexible. You can even change it to a product that has a death benefit.
Yeah.
Okay.
Yeah. You change the flags, and pricing model would have this as one of the benefits. The premiums would change accordingly.
Right. But if you put a 1 in place of maturity benefits, what would the term be? 5 years?
Yeah. So it's model will do what you will tell model to do.
Right. Okay.
Yeah. For this configuration, it would be 5 years.
5 years. That is what I was asking. Okay.
Yeah.
So let's move on.
Before moving to decrement table, let's have a look at the assumptions for reserving.
Right.
There's a MAD flag, which essentially says that if it is 1, you would apply margins to your reserving assumptions. And if it is 0, everything aligns with pricing. It's more of a check that your all assumptions linked to pricing are correctly being used for reserving, and there is no disconnect between the two. So if you turn on zero, everything would align with what you see in the pricing assumptions. So let's actually do it, if that's okay. So you see, the fixed expense was always same because fixed expense happens right in the beginning of policy inception, and you start reserving only when that time has elapsed and at the end of the month. So that would not have changed, but everything else now aligns with what you see in the pricing assumptions. Plus, there are a few more things. For example, solvency margin factors that's used to calculate the additional capital or solvency margin, whatever you want to call it. And there is risk discount rate, which essentially factors in, is essentially an indication of what rate of return shareholders would want on the capital that they have put in. And it's an indication of what you would earn, let's say, in a stock market. But then a stock market would have all the risks diversified, and you're putting in all your money in insurance, so you don't get the diversification benefit. So that also come in. And then there are regulatory challenges because it's an insurance business and highly regulated. You add more margin to it. In India, it typically comes down to about 13-14%. For US, 10% seems to be on a higher side, but then there are justifications to it. Okay. Yeah. Let's now have a look at the decrement table. Essentially, you start with one life in the beginning of the year. Then you say, okay, some people would die. Some people would be diagnosed with cancer. And some would have lapsed during the year,
Yeah.
continue in the following year. And then you have remaining lives at the end of the year.
Okay. Yeah, that makes sense. We have seen such tables when we are studying
Yeah.
competing risks in CT5.
Yeah.
So,
Yeah.
yeah, this is something very
Yeah.
similar to that.
Yeah, and what I've done is I've made mortality and morbidity as competing risks and assume
Right.
that they happen during the year,
Right.
but lapse happens in the end of the year because that's essentially reflects reality, right?
Right. Right.
People, once they have paid annual premium, they won't lapse in the beginning, in the middle of the year. They
Right.
will only lapse when when the next time comes to renew the premium.
Makes
So
sense.
yeah, so it's a uh, multiple decrement model with two competing risks.
Right. Okay.
Yeah. And the formula are same as what you see in CD5. So the formula is essentially same.
Okay. And you have assumed 5% lapses.
Yeah, 5% lapses. Yeah. Let me change the flag to 1 again so that MAD is on. And then we move on to reserving calculations, which is below it. Yeah, so which is what you see here in this table.
Okay.
Uh, if you now compare the reserving assumptions with the pricing assumptions, you would see that I've expected higher renewal expenses and commissions. Commission is a constant, but renewal expense is higher.
Makes sense.
17% as opposed to 15.
Right.
Lapse assumption is higher. Mortality is lesser than the pricing because if less people die, it's worse for you because more people would be liable to get cancer risk benefit.
But because people are only getting benefit when
Yeah,
they're getting cancer, right? So if they
right.
die before getting cancer, that's good for you, right?
When you're reserving, you're making it conservative. So you're making an assumption that less people would die.
Okay, yeah, makes sense.
Yeah,
So
that's why
that's
it's
worse for
90.
you.
Yeah, yeah. That's why it's 90 as opposed to 100 for
Okay, makes
mortality.
sense.
And morbidity, it's other way around.
Okay, perfect.
Okay. Yeah. So, this could actually get complex when you have, let's say, endowment product, wherein you have this concept of asset share. So,
Right.
in an endowment product, typically, if people lapse in the beginning of the policy term, it's worse for insurance company, but better when they lapse in the later half of the policy term.
That makes sense
So you,
because usually
yeah,
the endowment sum is very large. The
yeah, very large,
period
and the surrender value is lesser as compared to the endowment sum
of
assured.
course, of course.
Yeah. And that's when you would actually want to get into details of not having a, a standard lapse rate throughout the term, but you would actually want it to change by the term as well.
Right, makes sense.
So it could be 3 in the beginning and then let's say 7 in the later half, or And that's the reason why you would use a cash flow model, right?
Right, right,
So that you could have assumptions, separate assumptions for, let's say, each year theoretically,
right.
which is what you can't do in a formula-based pricing.
Okay, right.
Okay. Yeah. We've already seen incidence rate table.
Yeah,
Let's now move to pricing.
yes.
Okay. So this is where the most calculations happen.
Okay,
Uh, Starting with the results, let's see what I could do, and then let's move on to the calculations.
okay,
Um, this company had premium of 450 for a particular model point, and I
right,
could come up with 447.
right,
And this is the difference. So essentially, I could reverse engineer within the approximation of plus minus 2%.
right, right. That makes
Yeah, and the calculation happens once you click the generate premium table, because
right.
this macro would essentially change the model points. It would start with 20 male, policy term 5, premium term 5, sum assured 5,000, 50,000, premium frequency annual, and this area, and then calculate premium so that the profit is 12%, and
Mhm.
then move on to the next model point and do it till it reaches the last model point, that is 65 female, 65 female.
Right.
Um, and that's the reason why when we were in input sheet, you saw 65 female as the model point, because that's where the model stopped.
Okay, okay. So that was the last one. Since you
Last one.
clicked the
Yeah.
generate part, it
It,
skipped to the last one.
it calculated every premium for every model point and stopped at the last one.
Okay, right. Makes sense.
Actually, there's another macro here, which is reset default settings.
Right,
And it makes a lot of sense, because when you do pricing in the real world, you tend to change the assumptions.
right,
Let's say you say, okay, let me make it to 20 more percent and see what happens. And then let's see, I make this to minus 5%
right.
and see what happens. And then what you see the differences because of the change in assumption, but you tend to forget that you have made the assumption changes.
Right, right, right. So
And it could
this
be,
involves a sort of sensitivity testing that you're changing, tweaking the inputs a bit, and you're seeing
yeah.
what happens to the output.
Yes, actually, it could be sensitivity testing, and it could also be when you're pricing the model, some of the assumptions you can't play around with, but there are some assumptions you can play around with. So that's when you see, okay, let me change the assumption and see whether the premium has come down or not and stuff. But then it becomes a problem or an operational risk when you do not change it to what it was originally or what you wanted it to be originally. And it gets worse when you have made so many changes and you do not know where all you had made changes. That's where this comes handy. So it would reset all the assumptions along with the formula. You see, it was 10% because I had subtracted 5% from it, but then it has now changed to 15%. Because what it is doing is I've already defined what my uh, formula for each cell should be, and which is essentially picking up values from the configuration tab. And once I've done with playing around with the assumptions, if I click this button, it would reset to what it should be. And if you want to make a permanent change in the model, go to model configuration and make changes here. So let's say if you want it initial commission to be 10%, make changes here because that's where it should be done. And it reflects here. Because when you're doing it here, you are making a conscious choice and doing it knowingly. But when you're playing around in assumption sheet, you essentially doing to see how it works, and then most likely you would tend to forget it. And you could actually make it more sophisticated by writing a smaller another macro. Says that when you close the spreadsheet, this macro is called automatically before it is actually closed and saved.
Okay,
So that
okay. Yeah.
yeah,
That fixes
that's where
whenever you do an error.
yeah,
Right.
yeah.
Okay.
So whenever you are closing the spreadsheet, the default settings are restored.
Right. Makes
That
perfect
would
sense.
ensure that your underlying product is not different from what you want it to be.
Okay.
Cool. Let's move back to pricing again. So this is where I've plotted the difference. If you see, it's within 2% margin, which I would say is uh, outstanding, given you one did not know what assumptions were being used, which was 80% of the assumption I had no clue of.
Right.
So okay, so now let's move on to the pricing calculations. Uh, Essentially, the amount of premium you get is function of two factors. One, the premium that you're going to charge, and second, the amount of lives who are going to pay premium.
Yes, of course.
Yeah. So that's what you see in the formula as well. If you see in the bar above.
It's blurring out right now.
Okay, so let's not get into the level of detail of formula. I'll explain the concept then.
Right.
Okay. Investment income is what you earn after you have got premium and paid for your expenses.
Okay.
So initial expenses, renewal expenses. After that, after you have paid for all of them, you earn some interest on that money.
Right.
And then during the year, some people would die.
Right.
But in this case, since there are no benefits to it, you see zero there. But you could actually see some cash flows because of people dying.
Okay.
Morbidity benefit essentially is the number of people getting diagnosed with cancer and that being multiplied with sum assured.
Okay.
There are no surrender payments or maturity outgo because that's not a feature of this product. And then as part of this macro, these are actually the actual cash flows that you would incur. Yeah. And reserve is more of a pseudo cash flow, but still is a component to your cost.
Right. We have done this in our profit testing in CD5.
Yeah. So every time, so each year you would see how much reserve has increased, and that would also be part of your outgoes or part of your pricing calculations. And since you have reserves, you would also earn some money on it. So that's some investment income on reserves. You have, after you have factored in all the inflows and outflows so far, you get gross profit. But once you have gross profit, you also pay tax on it. So you take out that. And then comes the solvency margin or the capital bit, which in this model is very simplistic. Factor 1 multiplied by reserves, factor 2 multiplied by sum at risk. And that's also factored in when you are pricing the product. Since you have capital set aside, it would also earn some investment income. So that should also be taken care of. And after factoring in everything that we talked about, you get profit after solvency margin, which is factored in reserves, taxes, all the investment incomes and expenses. And this is essentially your profit stream. In order to make 12% profit, which is what we have targeted, the present value of this profit should be 12% of the premium, which is what our pricing metric is. So if you see here, what I've done is I've calculated present value of this particular column and discounted them at a risk discount rate. And then goal seeking it so that the profit margin is 12%. The goal seeking bit happens macro. So yeah, so macro would essentially this macro what the macro is the only thing this macro does is starts with the premium number and then sees what is the profit margin.
Right.
If it is not 12%, it will change it again to some number and see whether this is 12% or not. Depending upon whether it is getting closer to 12% or away from 12%, it would come up with new numbers, set of numbers,
Right.
and stop when the profit margin is 12%.
Okay, so the algorithm gets us to 12%, right?
For all model points, it will be 12%.
Right. That's great.
But in real world, you could again make it more complex by saying that, okay, I would want to make, I'm okay to make lesser profit for, let's say, younger ages, but I would want higher profits for higher ages. And your target profit could actually change depending upon each model point. But then again, the idea is to have a understanding of how the model works this fits in well. Yeah. And you have similar calculations to arrive at reserves, because you need to know how much reserves you are holding and how much it is increasing every year. That calculation happens down here. Similar to what you saw above, but the only difference is that now we are using the reserving assumptions, which are more conservative. And we are not factoring in tax here because you don't reserve for profit and tax. Right? Essentially, then you are making it circular loop, and you would reserve for adverse scenarios, or not saying that I want to have so much reserve that my profit should also be released. That's where the profit doesn't come in, and that's why it has lesser number of columns here. Uh, uh, well, yeah, this is all the model does and all it has. Any questions that you might have now?
Yeah. So, Sumit, this was really reassuring for me because I could relate to so many things I have studied in the curriculum in CT4 and
Yeah,
CT5, and
yeah,
that is applied
yeah,
directly. So, I always
yeah,
had
yeah,
this doubt that how much would we be applying in the practical scenarios that we study in the exam. So, that's just great.
yeah. Yeah, that's the best part of this course, the entire actual course. Everything that you study gets applied one way or the other, or most of it, I would say, which is not true with, let's say, engineering that I did, or let's say, uh, the courses that I studied in school. The best part of actual science is that everything that you study gets applied somewhere or the other.
Okay. Another thing I observed is that you have used a lot of macros. So, VBA is an essential, right?
Yeah, VBA helps a lot because let's say in this particular example, if you're calculating premium, you want to calculate your model. You want your model to calculate premium for each of the model points. One way of doing it could be changing a model point every time and then running doing goal seek and then putting in that number. But that's not the most efficient way of doing it. Whenever you want to do something repetitive, it makes a lot of sense to have macro, which also makes it a bit robust in sense that macro has an underlying code that you won't play around very frequently with. Uh, but then it comes with a word of caution as well. Uh, uh, if you do not understand what's happening in macro, then it becomes all the more difficult.
Right. So
This
you
is
can't see it, keep it as a black box, right? You have to do it
yeah,
yourself.
yeah, and that's the challenge with most people that I've seen around, even those who are employed, been around for a while, especially so when people put in a lot of reliance on the model, they think that whatever model is generating is right, and that's when you start becoming slave to the model.
Right. So that creates
Uh,
a false sense of security, right?
right, that you have a model and model cannot be wrong. That's absolutely incorrect. And that's where I think your judgment in terms of and feel for numbers. You should know, okay, if I change this, you should, even before what your model tells, you should have a feel for number in terms of whether my premium would increase, decrease, or if it's going to increase, it should increase by what amount. And then that's only after you have done that bit of back of the envelope calculation, you should run the macro. And that gives you a lot of confidence in terms of what you're doing and your model is right and also your understanding is correct.
Okay. That makes sense. Right. So that is where an actuary differs from a programmer or someone who has
Yeah.
only a computer background. You know what the numbers are saying, right?
Yeah. Yeah.
Yes.
You should have complete control on what your numbers are saying, because these could have long-term repercussions, right? Once you have priced a product, it stays around for multiple years. You just can't afford to uh, come up with a number which is incorrect.
Right, right. Of course, of course. So,
If you sell a term product, it is there for 30 years.
yeah,
That's the premium. Once the premium is decided, that's the premium people are going to pay for 30 years.
right, right. Okay, that makes sense. But tell me one thing. So, I see a lot of automation coming in these fields, pricing as well as reserving. So, do you
Yeah.
think a computer will be able to replace an actuary in this area eventually?
I think um, I think some part of what we do could be automated, but then there's a lot of judgment involved in what we do. For example, how do you come up with, let's say, a risk discount rate when you have absolutely no uh, data points? Wherever there is a clear-cut formula, okay, machine can replace us. But what happens when you do not have a clear-cut formula?
Right. That is where your
What?
judgment applies.
Yeah, and you become irreplaceable when you learn more. So yes, you could do pricing for so many products, but the world is changing. Now people are, as we were talking about in the beginning, people are getting premium discounts for exercising. I don't think many of us actually even imagined it a few years ago. And there are only limited research papers which talk about what should be the discount or what is the reduction in risk, and that then it becomes your judgment. Should I give so much benefit or lesser than that?
Okay.
Uh, in India as well, and I could be slightly wrong here, but my understanding is Apollo Munich Re gives you a premium discount of 8%, but Aditya Birla Health Insurance gives you a premium discount of 30%. I could be comparing two apples to oranges, but 8 and 30% are two very different
Yeah,
numbers.
yeah. Why is that? Why is there such a
Yeah,
difference?
I have no clue. So people who are closer to those products would know it better,
Okay.
but I do not have an answer
So
to it.
do they operate
But
in
and that
different segments or something like that?
it could be. I haven't spent a lot of time trying to figure that out.
Right.
But then, regardless of what are the differences, the difference of 8% and 30% looks huge to me,
Yeah.
and that's where the judgment comes in, right?
Okay.
You don't want to give so much discount that you start making losses, but you also do not want to be so conservative that your competitors are ahead of you.
Right. So you need to make a balance between your
Yeah,
price as well as your risks.
yeah.
Right.
That you can do very well when you have a lot of data to rely on.
Right.
But what about the scenarios wherein you have no data?
Right.
How many of us or how many insurers would have data in terms of what is the link between exercising and let's say cancer risk?
Right.
Cancer people are using this is for only 5 or 7 years. The longest research that I've seen is for 20 years.
Right.
And but then in 20 years there are 200 more types of cancers that have evolved.
Right. Right. Right.
And there are anomalies to it as well. For
Right.
example, you could say that when you exercise, your cancer risk has reduced.
Okay.
But then how do you justify Yuvraj Singh's case when he was exercising 6 to 8 hours every day?
Of course.
How
There are a
did
lot of other factors
yeah
involved here.
yeah
Right.
yeah? So the point is when you have a straight approach, formula-driven method, yes, machines can replace us, but the world is very different. The real world is very very different.
Right. Okay. So this model is a very simple one, and it has been wholly and solely designed by you yourself. But
Yeah.
there must be more complex kind of models. So are the teams very large on them, and what kind of
No,
people
it's
work
not.
on them?
No. Not really. So let's take an example. Essentially, I would say there are 4 people in the team, uh, but then 2 people essentially doing most of the modeling
Right.
and remaining 2 reviewing the work.
Right.
So a company like which is, I would say, doing large amount of business
Right.
and selling different multiple types of products, still had only 2 people who were doing the job.
Right. Right. Right.
So, but then I think when let's say risk-based capital that's going to come in India in 2021, and IFRS 17 would come in 2021 around the same time, you will need a lot of people with a lot of skills.
Right.
And one of the reasons why teams are small because they're not writing so much business.
Right. Okay.
So how do you justify the cost of hiring so many people while the business hasn't changed substantially over the years?
Okay. But if we talk about other countries, if we talk about the developed countries, there must be huge teams working on these models.
Yeah, yeah.
Okay, okay, and that involves a lot of people from non-actuarial backgrounds as well.
I'm not very sure of it. But then let's say there could be scenarios wherein you need only programmers doing the codes for you,
Right.
and actually is playing around with the model.
Okay.
Uh, but I do not have much feel for the numbers there, so won't comment on it.
Okay, okay. So I was asking, what other types of computer programs do you use apart from Excel to model such scenarios?
I've used only Excel. But then I've also used proprietary softwares like Moses and Prophet.
Okay.
But uh, well, I'm doing it on my own. I would use Excel.
Okay.
R is a tool which I started learning, but then somehow could not pursue it for long.
Right.
And I'm not sure how helpful R would be in terms of doing what we do.
Okay.
But in terms of data analytics, it brings in a lot of value,
Right. Right.
especially when you have a huge amount of data, even for reserving, like for example, a lot of time that reserving actually spend on is cleaning the data quarter on quarter.
Right.
So
Right.
that could be automated, and R could help you in finding out oh, which are the odd datas
Right.
that it could do because of its
Computational
capabilities in
power,
terms of
maybe.
computational power and the way has been designed.
Okay. That's great. That's great.
And you can do so many graphs within a flash to see, okay, that's to figure out where the problem lies.
Right. That makes sense. So yeah, I think that's all I wanted to ask. And do you want to say anything else to our students?
Yeah, all the best. Be consistent and be patient. I
Okay.
think
What
that's the
about
trick.
your firm hiring? Like, what do you look for in freshers?
I'm not hiring anytime soon now.
Okay.
I've started only a month ago, and I do not see any opportunities as of now. But when the time comes, I'll let you know and let everyone know.
Right. So, but still, what does a actuary in your position look for in a fresher in general? What are the abilities that you're seeking?
I would say someone who is willing to learn. That's more than sufficient for me to start with, and be committed to the profession, because you would want to see some commitment in terms of, let's say, clearing exams, learning new things, being able to pick up new things, be open-minded in terms of not being restricted to saying, okay, I'm doing pricing, I won't do anything else. That's a very negative way of approaching things, because what you're doing now and what if you learn a few more things, that comes very handy when you're doing something else. So if you're open to learn and have a willingness to pick up new things, then I think that's all most people would need. But then the challenge right now, I understand in the industry, and I'm also working with the institute on this, is that you already have a lot of people who have cleared so many exams, and some. Right now, that's actually my perception, and I could be wrong. Uh, there are already people who have exams under their belt and have some experience, and they are already working with one or the other insurance companies. Most freshers have a lot of exams, at least 6 or 7 on an average. That's my perception, and finding it difficult to get a job. So, and that the institute is trying to bridge in multiple ways. One, they're trying to encourage internships, which works both for the insurance companies and for the students, because interns get an opportunity to showcase their talent, their willingness, their attitude, and then insurance companies get an opportunity to hire someone at a slightly lesser cost, but also be able to judge whether this person would fit in well or not. And and then there would be movements every time, right? I got an opportunity into actual team, but because someone else moved to somewhere else. The only thing that worked for me was I was at it. I was consistent. I was clearing exams, and I had I've been meeting them on a regular basis. So I was not out of their mind.
Right. So that's what we need,
That
a good amount of professional networking as well.
yes, that helps a lot. Well, why would someone want to hire you and not someone else? One, talent and stuff, that's given, but then that's not the first impression. You don't get to know by seeing a person what his or her capabilities are, but you would know a person because you see him or her more frequently, see him or asking questions, relevant questions, genuinely interested in the stuffs that he's interested to do. and that gives you the for that gives you an opportunity, and then talent comes, which gives you an opportunity to convert opportunity to a real life, let's say,
Benefit.
uh, yeah.
Okay. Yeah, that
So networking helps a lot. Yeah.
yeah. Okay. So I think
But then networking has to come with right amount of balance in terms of capabilities as well. So
right,
the balance is, as someone said, is godly. You
right.
could be in one extreme doing extremely well, but it's very hard to strike a balance.
Okay. And in terms of software skills, what do you advise freshers to learn at this moment before they even start working?
I think Excel is good, VBA is good. SQL is also helpful, especially when you're doing with large amount of data.
Right,
Um, or if you could, but then uh, again, the point around striking the balance, you could learn softwares, but you should also be able to understand the actual concepts where it's getting applied.
right.
So software skills are good, but application of those are more important. For
Mhm.
example, this model that we just walked through could have been done in a Profit. So you know Profit, but then the point is, do you also understand how Profit works or how the underlying model works?
Right,
So the Profit helps in doing it efficiently and doing it correctly, because a large part of it has been modeled, and you need to play around with the assumptions and change formula a little bit here and there, and then you're done.
right,
But then do you also understand how it works?
right. So you
So
need to
while
understand the
while
logics behind everything, right?
yeah, yeah. So the software is important, but how it works is equally important.
Right. Okay, okay. So I think that is all I wanted to ask you. Okay.
Yeah.
Thanks a lot for taking time, and I think it has been a great learning session for me as well. I learned a lot, and it
Yeah.
gave me a sense of reassurance that we will be applying the same things that we study. So that's just great.
Yeah, yeah, yeah,
Yeah, that
yeah.
gives you us an incentive to work even harder on the concepts.
Right. And thanks for giving me the opportunity. I think at this point in time, I'm at a stage where I can give back to profession in one or the other way,
Right,
and this is one way.
right.
Um,
So
so in that sense, it was my pleasure.